Everyone. Thank you for joining us on your busy Saturday. I'm Steve Sabaji, one of the IRA specialists here at Quest Trust Company, and I want to welcome you to our self-directed IRA Saturday. The title for today is a rather long one. It's called Tipping Point. Is it time to pivot? Being the landlord versus being the bank with Martha Speed. Now, I need to just let you know that Martha was not able to attend our session today, so this is a pre-recorded session. However, the information, it is very timely. It is very important. Martha's one of our favorite speakers too. And this does kind of reflect the topics that we've been getting asked a lot as IRA specialists here. So what we're gonna do is show you the presentation. We're gonna ask if you do have questions that you still submit them to us by way of the chat box. And we will forward those questions on. So just give us the questions, give us your contact information, and your questions will be answered. Now, with that, I'm going to go into my brief presentation before we begin and start talking about us here at Quest, just give you the overview as to who we are and what we do. Many of you may be familiar with this. For those of you who are just joining us, we'll tell you a little bit about who we are and what we do. First of all, Quest is the largest self-directed IRA custodian in the state of Texas. We do have, however, a nationwide clientele of over 20,000 active clients all over. We currently have, under our custodial administration, over $2 billion in assets that is actively deployed and in retirement accounts. We have over 100 employees, and many of them are certified IRA specialists, which means that they have higher education and are very well qualified and specialized in the IRA field. Unique to Quest at this point in time as well is that right now our clients have in excess of $350 million sitting in cash. That means that they are ready to make deals. They are looking for places to deploy their cash, either in the way of buying real estate or buying into partnerships or even lending. So we have a lot of clients motivated and they're ready to make deals. Now, just as a quick disclaimer, just please bear in mind that we at Quest Trust Company, we don't sell investments. We don't recommend anything. We don't act in an advisory, legal, or tax capacity. The information and our function is purely that of being educators. And this presentation is also just purely for educational purposes. Now, a little bit about self-directed IRAs. First of all, self-directed IRA is really just more of a marketing term. There's no difference between an IRA that you would get at a Fidelity or a Vanguard versus an IRA that you would get at Quest Trust Company. Self-directed just means that you truly are in control. You're allowed to use private assets, or sometimes referred to as alternative investments. Now, there are a lot of advantages to doing so. First and foremost is diversification. When you are investing in the stock market through either stocks, mutual funds, ETFs, no matter how diversified you think you are, you're never as diversified as that. Now, when you are able to utilize a self-directed IRA, you truly do get to pick a different asset class altogether. And if you're talking about something in the case of real estate or real estate investment related asset, you really are using something that does not correlate to the stock market. IRAs also, as many of you know, offer tremendous tax savings advantages. Contributions may be deductible. They are always tax deferred while they are in the IRA account. And in some cases, they can even be tax-free on distribution. And this is tax-free distributions you can use for a variety of different goals that one has in their life, retirement being at the top of the list, but also for things like medical expenses and education expenses as well. An element of self-directed IRAs that often goes a little overlooked as well is that of social investing. Now, the social impact comes from the fact that, let's say you are purchasing a piece of real estate in a neighborhood with the intention of renovating it and beautifying it and perhaps flipping it or renting it out. The fact is that you're going to be doing this in the local community. So in all likelihood, you're going to be hiring local contractors. You're going to be spending the money locally. You're going to be improving the economy that way. And of course, the end result is that you are going to have a nicer property, and it is going to raise the value not only of your own property, but that of the community as well. So it's a way in which you could say you're kind of doing good for the community and you're doing good for yourself. And then finally, again, here you are dealing in a truly private asset. So you are dealing in something that you really know best, as opposed to investing in, say, a mutual fund where it's a manager who chooses what you invest in. By using a self-directed IRA, you really get to pick your own deal. If your specialty is in real estate, or if it's in multifamily, or if it's in storage, you get to pick your deal. Now, the types of accounts that are out there, they fall into three buckets primarily: the personal plans, the employer plans, and specialty plans. So the personal plans would be things like the traditional IRA and the Roth IRA, both of which have different features and different advantages. The traditional is also what we would refer to typically as the rollover IRA. Employer plans, these are variations on IRAs, which will allow you, if you are a small business owner or even self-employed, to go beyond just those personal contributions that you could make in a personal IRA and have the potential to put much more money into, and also potentially have it as a business expense. Those are things, again, that the IRA specialists, we can go into more detail with you on. Finally, the specialty plans, these are related to specific types of savings issues you may have, that being healthcare and education. So we offer the health savings account, which can be paired with a high deductible health plan, as well as the Coverdale savings account, which is, again, allowing for tax-free distributions for qualified education expenses. And again, any of the IRA specialists here at Quest will be happy to go over these different options with you and give you more details. Quest has just recently unveiled our new client portal as well. And I will say that I've been getting a lot of good feedback on the portal. It has really simplified a lot of things for clients in terms of their interactions. The portal will allow you to pay expenses directly. It will allow you to upload the documents that may be necessary, secure message with various representatives as needed. It basically now is your portal to investing as well. It has made the process a lot simpler, much quicker, and there is no drop off in the customer service. You still will enjoy the ability to interact directly with a specialist for the type of asset that you are transacting with. Now, we all know that Quest offers ongoing education to all of our clients and potential clients as well. That is one of the cornerstones of Quest and what we do. So we will continue to have ongoing sessions like this, and we are looking forward to that point where we will be open again live, which will be coming very soon. For those of you who are in the area, we had to postpone our recent reopenings. However, September, we are very hopeful that we will be going live again. So stay tuned. In terms of other resources, our education is always ongoing. As you know, you can find us through our YouTube page, our Facebook page, and our website itself. We have our weekly webinars, which we will continue to do as well. We usually have anywhere from 3 to 4 different items a week. Self-directed Saturdays like today, and our notes school, which is always ongoing, as well as many others. Promotions that we're running right now. There is our rewards for deposit. So if you've been holding off on switching some money over, this could be the opportune time to do so. Deposits of over $100,000 will get a $125 credit, which happens to be the price of a transaction. So if you put in more than $100,000, Quest is going to pay for your first transaction. And of course, higher deposits earn higher credits. One of the final things I want to talk to you about is, of course, the referral plan that Quest offers. It always pays to refer a friend to Quest. If you are a current account holder, then tell your friends. Your friends will get a $25 credit toward their account opening fee, and you yourself will get a $25 credit to your account for the referral. This is an unlimited benefit as well. So the more people you refer, the more credits you can earn. And as I wrap up, I just want to let you know that there are ways that you can get in touch with us directly. So if you would like to schedule a consultation with an IRA specialist, please take advantage of the QR code that is on the screen as we speak. And don't forget, there are other channels that you can get through to us as well. You can always go to our chat feature, which is available during our business hours through our website at questtrust.com. You can always give us a call through our toll-free number, 855-FUN-IRAs. And of course, you can just send us an email as well. And currently in our chat box as we speak, it's being moderated by my friend, Sarah, and she will be putting a lot of this information in there as well. And so with that, we're going to turn it over now to the presentation for Martha. Thank you very much.
Hi, I'm so glad to be with you today for the Quest educational series that they've been doing every Saturday now for a while. My name is Martha Speed with Colonial Funding Group, and I'd like to visit with you today about investing in notes. Investing in notes has been a great strategy for myself and my family. I've been in the business now for about 40 years, as many of you know, if you've heard me speak before. I started when I was about 17 years old and working for my dad in his office. And so it's been a great journey for us, and we want to introduce you to it. I hope you have some water. It's really hot today and you're just comfy in some shorts and flip-flops because it is Saturday. So I hope that you guys are just kind of laying back and enjoying the day and the presentations from Quest. At the end of the session today, I'd like to give you an opportunity to do a few different things. First of all, there is a link for a video that is called Notes versus Rentals. And we're going to talk today about being a landlord and the versus being the bank. So not that the presentation is only for landlords. It doesn't matter if you're doing maybe hard money, you're loaning out hard money out of your account, or maybe you were just a capital investor and you just have capital that you would like to invest. Either way, we just want to show you how being the bank has helped my family, and it's helped us to grow generational wealth and to create a legacy for our family. So first of all, there is a video when we get through today, and I want you to watch that. I have a testimonial from some customers that have become good friends of ours from the Nashville, Tennessee area. And so please read through the testimonial. And then I'd like to offer you a free strategy call. Now, why would I offer this for free? I'm sure a lot of you are asking. Well, there's just a couple of different reasons. First, like I said, this business has been really good to my family for generations. I'm the second generation. All of my children now who are young adults are also investing in notes and different areas of real estate. And so, we feel like it's a situation where we always need to give back, and without expectations of anything in return. Secondly, there's just nothing really to sell today. It's educational. I just want to show you how notes work. And what I personally, my strategy that I use when I invest in notes within my IRA, and also when other accounts, you don't have, it's not specifically just for IRAs. But I want to be here to answer any questions that you have. So the strategy call can allow me to answer those questions. So if you'll make notes along the way, we find that everybody has, usually questions that are going to apply to them personally. And so if you'll jot down your questions, then I'll be able to answer your questions once you get your strategy call scheduled. And there's always the opportunity for us to do business together. So I do look forward to visiting with you. We're a very kind of close-knit group of investors as far as the investors that I work with, and it'll just be great to visit with you, see if this would be something that would be a fit for you, and then maybe we can do some business together. So let's get started. I'm glad to be with you today, and we're going to talk about is this a tipping point, and is it time to pivot? So being the bank versus being the landlord, or I could say being the landlord versus being the bank. I imagine a lot of us have been in and out of the real estate market and seen a lot of the different cycles. We were back in 2010 buying like crazy because all we had to do was jump on MLS or some other site, and there were plenty of assets there to buy, and they were at the right price, right? And now we've gone the other direction, and the assets are at a all-time high. And so it may be a time to look at maybe diversifying your portfolio. So let's talk about a couple of the, well, it's not, let's see, my PowerPoint's not moving here. Let me click on it and see. There we go. All right, so let's talk a little bit about who owns rent houses or rentals. Personally, I would have thought that, these big corporations or REITs basically that have come in and bought so much real estate would have taken over the rental market. But the reality is that 72% of the market, which is almost 17 million properties, are owned in individual names. So we see that, we have a lot of landlords that own anywhere from 1 to 5 or 1 to 10 properties. They probably did buy them about the same time as that I was doing fix and flips. And I'm sorry, I'm going to adjust the camera just a little bit. And also kept some rentals, but I have sold out of the rental market as the prices have gotten so high, and reinvested some of that money in my LLCs and different entities and notes, just like I do in my retirement accounts. And then the second area that has a large percentage is limited partnerships with 16%. And then we get to the corporations and the REITs with 2%, and then an unknown of 10%. So it's really just interesting to me to, when we put all of this different research together, to find out that we have so many individuals that own rentals, and I totally understand the structure of that, and just the way that works. I grew up with rental properties, you get your loan paid down. Most had mortgages when I was growing up, and so my dad worked to pay the mortgage down and get that paid off, and then he had free and clear cash flow coming in. So it could be a great passive cash flow strategy. But we've had this issue now with tenants not paying rent. And so not only that, but we found that a large percentage of people, individuals that own rentals, that they're self-managed. So out of the percentage that we have, the millions of dollars worth that people own, $14 million worth of those or 14 million properties are self-managed. And so, 1 in 7 landlords change light bulbs I mean, I don't know about you, but I don't want to go out and change light bulbs. Now, when I had a lot of rentals, there's no doubt I did have a maintenance guy, and I would send him out to, twice a year, check on like, the AC filters, make sure those were getting changed. I mean, or quarterly or whatever, just send them out on a regular basis just to make sure the maintenance was being kept up so I didn't have issues to deal with down the road if the tenants weren't taking care of it. So, maybe changing light bulbs is just a way to kind of make sure things are being maintained, and I can certainly understand that. So but we have a lot of self-management, and I personally am looking for something that's totally passive, that I don't have to spend a lot of time doing nitty-gritty little time management type things, but I can oversee the big picture and just oversee the assets at an executive level. And I would imagine that's what most of you are looking for. So then we do have 4.5 million that are professionally managed, and I just thought that number was going to be substantially more. So I've been really surprised about that. So now we have a Wall Street Journal article as of July 2021, which is, as we all know, we are kind of at the end of the eviction moratorium, and now it's like where are the tenants going from here? So tenants could be at risk of losing their homes. I'm not saying they are if they have, maintained their employment and been able to work from home and have made an effort to communicate with their landlords that they can pay something every month, even if it wasn't the full amount. Or maybe the landlords might have to adjust rent sometimes to allow them to stay. I'm not really sure exactly how that's all going to work out. But we still have a situation where we do have tenants that can't pay rent. Like 8 million tenants that still cannot pay rent. And so this is really significantly affecting landlords that are in that bracket that only own 1 to 10 properties. And we fund, we kind of call them hobbyist landlords. And I would put myself in that category because by the time I had run a fix and flip model, most of when I really kind of eased my way out of that and back into notes, then the majority of okay, I just wanted to, I'm sorry, I was just stopping to read the notice here on the back of the web information to see where we were, see what it was, the message that it was giving me. So I would put myself in that category. I did own less than 10. And like I said, as the market has risen and property prices have gone high enough that we're in this bubble, we would call it, then I have chosen to sell many of my rentals and just had one left. So I had a tenant that had paid so well. She'd been there for 7 or 8 years. When all this happened, she never missed a beat. We communicated a lot. She had always worked from home, and then her husband also had started working for the same company. So they were in a good situation as far as employment. And so I just let her stay. She was actually moving or planning to move because they had started building a house out by her mom, kind of a barn-dominium, so that they could help take care of her mom. And of course, with COVID, that got delayed. So the reality is now we're just getting to that property, which will be my last rental that I'll be selling. And I just found that for me, not to have to deal with the rental was just a lot less headache. And if my property's free and clear, but I can take the investment money that I'm going to get because prices are so high and reinvest that money in notes. And so, are you at a tipping point? I think that's the question today. Are you at a tipping point? Do you need to look at some alternatives, some diversification in your portfolio, even if you're not a landlord? So let's say that that maybe you're a hard money lender. Well, for me, I would be a little bit concerned today because prices are so high, and you do still have a lot of real estate investors that are out there buying properties, rehabbing, flipping the properties. So if I were doing hard money loans with prices at an all-time high, I do realize there's money to be made there, but I also realize that you could end up with those properties as owning them as a hard money lender if the market were to drop significantly just in an instant. Like, we think that's not going to happen, but we've seen it happen. We know it can happen. And so, or maybe, you're just in a situation where you just have capital to invest and you're just looking for other alternatives and to diversify. So we have seen, because we do have a lot of contacts in DC, we do some lobbying there, and we're just concerned about what has happened with this assault on landlords that has come out of the federal and the state and local governments. One in particular is called the United Neighborhood Defense Movement, and they have recently said, and this is a quote, that housing is a people's right and should not be a cause for private profiteering. Well, I don't consider my investments private profiteering. As a matter of fact, I go over and beyond to work with my borrowers if they get in trouble and can't make the full payment. We can always modify their loan, and we can talk about that some more, but there's different strategies that you can use to help a borrower stay in their home. And so we don't know where all this is going to go. We don't know, potentially if there might be another government bailout like we had before in regard to mortgages that do become delinquent, where, we might end up getting some of the money they couldn't pay, or if we had to adjust their loan, maybe getting some federal funds from that again, as we did before. But I'm not sure that that's going to happen. We also had a Minnesota congresswoman that says that to outright cancel the rent and forgive it. So whatever rent you haven't collected, it was kind of, to me, she was implying, the tenants need to be able to stay and you need to forgive their rent. Well, we don't necessarily forgive rent. Like, for example, if we have a borrower, we don't necessarily forgive 12 months of payments, but maybe if they get delinquent and we can defer 2 or 3, it doesn't mean we're not going to collect them. We just collect those payments on the back of the loan. So, that might even be an option. I mean, there's just so many different things that you can do with mortgages, but this is calling just forgive the rent, just don't collect it. Also, another thing that's come up is the 5-year rent control, to put rent controls in place. That the landlord can't review a tenant's credit history or criminal record. Well, I'm not sure about you, but when I was a landlord and had a lot of rental properties, and growing up, even because my family had a lot of rentals, that's what we depended on, was going back and looking at somebody's credit history, getting references from their previous landlords, and getting verification that they had paid on time. And today, we almost have to look at criminal records because, I'm in a bad situation and you're in a bad situation. If we go out and we put somebody in a rental property that has a criminal record, and then we put them into a safe neighborhood and the neighbors don't feel safe anymore. So that concerns me. So there's also a push for new legislation that can have you giving 10% equity in your rental to your tenants. So I don't know how they could really get that passed. I'm hoping our government doesn't go that direction. I just feel like I own that property. I bought it with my money. I own it. It's my equity. Just because I allow someone to sign a lease and agree to pay me a certain amount per month to live there, I don't feel like I owe them equity in the property. Now, that's a different situation. If you're doing a lease to own, you might consider doing something like that. But we're just, as far as I know, we're just talking about straight out rentals. So a simple pivot can help landlords not only survive, but thrive. And of course, we're talking about notes. So let's talk a little bit about who makes money from financing. And it's not just banks. So you've got a car dealership, for example, and they sell you a car. There's not much money that is made on the sale. You would be shocked at how little profit that is made when they sell you the car. So they push really, really hard to keep the financing in-house. Then they have a lot of add-ons, well, extended warranties and all kinds of things. I can't remember all of them off the top of my head, but I'm just saying they have a lot of add-ons. And then every time you add a feature on for protection, let's say, and I'm not saying they're all bad, I'm just saying every time you add some type of package onto your acquisition or your purchase, then the dealership is making that money. So that's really where they make their money, is through financing, and they roll all of that, all these packages that you add in, they roll it all into your financing, and that's where they make their money. Furniture stores have kind of the same type of situation. They do a lot of in-house financing. You will find people that will go and maybe buy furniture for a whole room or a whole house. I actually had a friend that she went one place and she bought furniture for almost the whole house and financed it with the furniture company. So they made their money primarily on financing. And of course, then the bank. So when the bank is collecting on a note and mortgage, they're making their money because they financed that loan, right? And they're collecting the interest, and you've got compounded interest, and you've got late fees that might apply. So they're making their money on the financing. So the reason that we really like notes is that we have been able to use it to build a multi-generational wealth and legacy building. And so if you've heard me speak before, it's just, it's something that my dad envisioned. He knew it could happen if he accumulated enough notes and they paid out long enough that they would pay out past his lifetime and past probably or possibly the lifetime of my mom. And we're going to look at that on another slide. But it's an amazing wealth builder, and it can also lead to legacy building as well. And you can push this cash flow into other generations. And it's just amazing how that happens. And so I've got a slide that I'm going to share with you on our family and how we have personally made that happen. But I know that with landlording, we all, and I myself, I'm like, this is great. This is going to be a great passive income. But, I just found that it was a lot more work than I expected. We certainly never expected anything like COVID. And so I think a lot of people are looking now for where's that next opportunity to find real passive cash flow. And we certainly believe it's in notes. And that leads to the freedom that we all really want. See, I'm in my 60s. I really want some freedom to where I'm not having to micromanage assets. I'm not having to do repairs. I just get to sit at an executive level, like I said earlier, and oversee the assets. So then that's where, and we're going to talk about this too, that's where we're going to talk to you about servicing and how it works on notes, so that you don't have to micromanage, but you do have to just oversee the assets. So let's talk for a second about how we work with passive investors. First of all, we focus on buying, and I do because I'm buying for myself and my accounts. I'm buying performing loans. Now, I'm going to show you a case study, and it's got a good, really good investment to value. They've been paying for a long time. They've got good loan to value. So you might not see all of them that high, but you're going to be really intrigued by it and how it works. So then we use note leveraging techniques. And I'm going to show you how I buy a loan. So I buy the full remaining cash flow on the note, and then I will work with a passive investor and let them come in and buy like a portion of the front end. Now that might be 10 years or 15 years or 8 years. I mean, we just kind of back into the numbers, and a lot of that just depends on your goals and what you're looking to do, and what kind of term you want, if we can make it work. So we use those kind of leveraging techniques. And then so many of my investors are previous landlords, and we call them burnout landlords because they're like me. They're in their 60s normally, and I'm not saying I'm just not saying they have to be the specific age bracket, because I realize there could be just a lot of landlords that are a lot younger than us, because when I actually had the rentals, I was a lot younger. But you just get burnt out on it after a certain amount of time. And then also we work just with capital investors, all of which are looking for the alternatives, looking to diversify, especially now that I think real estate's hit such an all-time high. So let's just talk about the mortgage and the note itself, and I know you're very familiar with this. All of you guys, I'm sure you bought a home, you've gone to the title company, you've signed the note, you signed the mortgage, and so you know how it all works, but we just always like to review in case we have somebody that might be younger that hasn't really gone through the whole process. So first of all, on the mortgage and note, you've got the terms of your agreement. You've got the principal amount that's going to be paid back and the interest rate. And then you've got the amount that's going to be paid monthly, or your principal and interest. The mortgage or note may also state if escrow is required. Of course, that has to be adjusted every year if it is required. And then you've got your amortization, or the term of the loan that's going to be paid back. And so a note is a promise to pay. So it's just like signing a check. It's like you're saying when you write a check for your lawn care company that you're going to pay them $150 to do your lawn, right? And they're going to go and they're going to give it to the bank and they're going to get cash back. So it's basically a promise to pay, just like a check. But it can also be called other things. We hear a lot of different terminology in the industry. Excuse me, I'm sorry, I've got to have some water. It's extremely hot here today. Such as paper, a home loan, or a mortgage. So I know you're familiar with these. We just like to review. Again, this is the typical sale. You've got a subject property, and you've got a buyer and a seller. And so the typical transaction is that the seller gives the buyer some type of ownership deed, and that varies by state. So different states have, different terminology for, which deed that they use. Then the buyer is going to sign a note, a promissory note, and a mortgage, which is traditionally held by the bank, and the bank collects the monthly payment until it's paid in full. So if it's their 30-year loan, they're going to collect 360 payments. And so what happens in these situations is that the bank then files the mortgage, which actually puts an encumbrance on the property in case they do have a default. And so that property is their security. But in this situation where the seller has actually held the note himself, the seller becomes the bank. And so he steps right into the place of the bank, which is what I do, except for most of the time I'm buying an existing loan that a seller, such as like in this example, has created. So then what I do is I'm actually, buying the full cash flow. I am buying all the remaining payments that they have available. And then I will have a passive investor that will step in, and he will buy the front portion of the note. So I sell a term of the loan on the front end to a passive investor. Now, this passive investor is going to collect the full amount due him or her. So their account's going to collect the full amount due before I'm going to see anything on the back end, or I'm going to get any money at all. So we used to call this mailbox money because, of course, and back in the day, it was a check that came in the mail. And so we just like to see the payment amount get larger and larger the more loans you buy. And we like buying and having a long payment stream. The other thing that we really like is we do the work one time for a long-term passive income. Now, you don't find that you do that when you're loaning out hard money, because as soon as that hard money loan is paid off, you got to have the next deal lined up, and you've got to do all your due diligence on that transaction, and then it's going to pay off, and you've got, there's a lot of back and forth money going back and forth, and it can happen very quickly, maybe 3 months, 6 months, 9 months, who knows, 12 months, but then you've got to reinvest. And you've got to keep that capital turned over. So we really like the fact that you can actually do your due diligence and one time and keep a note for a long time. So this is where I want to talk about different strategies for different ages. And this is where we get into the multi-generational legacy building. So my mom, we call her Nana, is 83 years old. My dad passed away in his late 50s. So my mom was very fortunate. She never had to get out and go to work. We helped manage the family business for my mom. My mom, when in her younger days, she managed a lot of the rentals and collected rent and those kind of things, but she was never really in the note business. And we've helped her and helped her structure, after my dad passed away, a situation where we took most of the cash flow, and my dad had collateralized some of the banks, some of the loans at the bank when he originally bought them, and we just took as much as we could other than what she needed to live on, and she doesn't need much to live on. We just paid the banks off as fast as we could, because that way all of that income was left for her and for her needs as she gets older. So what happens with that, though, is, even today she will have loans on the books that, let's say, they're 15 years still left to pay out on them. Because as she's had capital to redeploy, we put more notes. We bought more notes for her. So she still has some pretty long-term notes. And if she does not, if the payment structure on those notes keep paying out past her lifetime, then it will go to my generation. We're having a trouble. There we go. Sorry. So it will come to my generation and my siblings because we're the beneficiaries. Now, we've done something similar. Now, my mom's account, her retirement account, was a profit sharing account. I think, back at that time, that was the most prevalent type of retirement account. Then it's gone to, it went to self-directed IRAs. So most of our accounts are Roth IRAs, and so we can do the same thing. So if my mom is going to push cash flow into my generation, and I don't ever need to take any money out of my Roth IRA, it's going to simply go over and transfer over to the next generation. And I have 3 children, and so they would be beneficiaries of my Roth and my husband's Roth. We have a lot of different kinds of retirement accounts. And then we also have Roth accounts for all 3 of our kids. So that allows them to do the same thing. Now, there are life circumstances where you might have to take that money. but it doesn't matter. If they're beneficiaries at some point in time, they could still benefit from the funds that are still there, and they would be dispersed to them as beneficiaries. And then, of course, for the youngest, we actually have Colt here, and this is his baby picture, but now we have a second grandbaby, and we did send a picture to get it updated for today, but it just got overlooked, and we didn't have time to go back and change the picture. But we also have Levi now. He's 5 months, and Colt is 2. And so, you know, of course, the CISA accounts, the Coverdale Educational Savings accounts, are just a great way to go for them. And I know you know a lot about those and how that works. And, you know, if one beneficiary can't use it, then you could change the beneficiary. So there are great ways to, you know, to help your kids get any kind of education they want. If they want to take horseback riding lessons, if they want to become pilots when they're 16, you know, just depending on what their interest is, that might be something that they would want to pursue as a career. You know, book expense, college, private school. You know, there's so many different things that you can use that for. So let's talk about the case study. This is a property that is in the Memphis, Tennessee area. It was a very nice neighborhood, very conforming neighborhoods. You know, many of the homes, they're not identical, but they are very similar, right? So it's not like a cookie cutter type neighborhood where you only have 2 or 3 floor plans, but very nice homes, kind of very typical, about in the same price range. So when I bought this particular note, the value on their home was about $220,000. Let's talk about the terms of the note first. I'm sorry. So when I bought it, the unpaid balance on the note was $160,000, and of course $316. But let's just say $160,000, and the interest rate on the note was 6%. So the payment amount was $1,081 a month. Now, I don't always see payments that high. I see between $550 and up. I have a few loans that pay over $1,000 and over. We do see them. I would say my average payment is about $750 to $800, somewhere around $800. But just so you have an idea about kind of how that works. And then the remaining term was 271 months. So this was probably originally a 30-year loan, I'm going to guess. They paid for a long time, and it's got a good value compared to the unpaid balance. And so it puts my loan to value when I buy the loan at 73%. So that gives me a 27% cushion, or actually not me, but the buyer gives them that equity position. But, you know, if I did, since the property, the home is my security, if I did have to take that back, I'd have some cushion in there. You know, so it's just a little bit about how the loan to value works and how it gives you some cushion if you do need it, if you have to take the property back. So the remaining loan balance, though, $160,000 at 6%, and then we had 271 payments remaining, and so I negotiated to buy the entire note. Now, I could always buy partial on the loan. That's not particularly what I like to do, but it's an option, but we always try to buy the full loan. So we have an established value of $220,000. Now, I brought a partial buyer in, and they bought, we'll look in a minute how many payments. I think 108 payments for $105,000. So that's their partial investment, 105. So if we look at the percentage of their investment compared to the value, well, their investment to value is 48%. So that's pretty amazing. We don't always see them this low. Like I said earlier, you're going to see a lot of them higher, but it's still an awesome little deal. And we will see a lot of those, because when you buy the front end of the loan and not the whole loan, then you're not investing quite as much. and you're not, you don't have as long a term, and so your investment to value can be quite low. So we like to show it this way also, which is important for investors. And that is that if you look at the full property value, you've got your investment dollars in the note, and then you've got your investment to value we call is a cushion. So you've got a cushion in the note where, if something catastrophic happens and you take the note back, as the market cycles, whether it's going up or down a little bit, then it can go down and you still have some cushion there. There's still equity there to make sure your investment is safe. So let's look at some positives and some negatives in regard to this particular asset. The positives being that the loan to value is great, and so is your investment to value if you had bought this loan. It has a recent good payment history. It's a great neighborhood, a very nice sticks and bricks neighborhood. There's clear title and the taxes are paid. So that's just a few of the things that we do as due diligence when we're looking at properties, not, looking at the property and checking title and making sure the title is clear, all those type of things before we buy the note. Now, on the negative side, some people look at this as, well, there's no current financials. Well, there are not current financials. So we really do rely heavily on a payment history. And that's, something that you're not going to always see extremely seasoned notes like this one was, but they'll be seasoned well enough that you'll be able to see that they can pay, that the borrower has the ability to pay. On this particular transaction, the buyer had actually had a bankruptcy, and we bought the note after they had declared bankruptcy, and it just paid like clockwork since. So we never had any issues. They paid great. And then some people see a long term as a negative. So just depending on how you want to structure things and where you are in your investments, just depends on whether you would want to hold a long-term note or whether you would be interested more in just having a partial interest in a note. So once again, we have a buyer. And what we're asking ourselves, I think, is, well, will they pay? Well, we look at their payment history. What does it look like? Their loan might be due on the 1st, but the reality is if they pay on the 15th every month, I'm fine with that. Or, what if they pay on the 30th? I mean, as long as they're paying consistently every month, that's what we look at. Then how much will be paid? Well, we've got a note that tells us how much is going to be paid back. It's going to be paid back according to the terms of the note. And then what is my security? What the property is your security. So the note term that's bought or sold, let's look at this just for a second, because I'm buying a long term. Now, then I'm turning around and I'm selling a short term of the front of the loan to the passive investor. So, like I said before, that could be 8 years, it could be 10 years, it could be 15 years. It just varies on every note, and we have a way to back into that and just kind of look at the whole picture and find the note that really fits what you're particularly looking for. So when we buy notes and we're buying the entire payment stream, we are buying the notes at a discount. We are not paying the unpaid balance. But on this particular note, I mean, we did buy it at a discount, but when I sold the partial, I sold 143 months. I can't remember what I said a while ago, but that's pretty close. We sold 143 months out of the 271 remaining. So on the back end, after the partial buyer has received their full investment entitlement on the front end of the payment stream, then it will revert back over to one of our accounts, whichever one I had bought it in, and it will collect 128 months on the back end of the note. So this happened to be Eddie's IRA, so he will collect 128 payments. Typically, we see when we're working with passive investors, approximately somewhere in the range of about a 5 to 6% yield per year. But it's a steady rate of return. So it's not up and down and all over the place like some investments that you might have that are changing daily or changing from time to time. You've got a steady payment stream, and it's a consistent yield. So once again, the way that the partial transaction takes place would be like I would step into the place of the deal architect. I would have a note seller that I'm buying the note from, and I would have a passive investor. So the passive investor is going to buy the partial, but first I'm going to complete a full acquisition on the note. Hopefully I can get it boarded with the servicer and get it set up and see that the payments are coming in on a regular basis before we actually sell the partial. Now, sometimes we will buy and sell simultaneously, but that's not our preference. But then once we get that done, the partial buyer will step in and actually fund the partial. And so in this particular instance, once again, they funded $105,000, and it was 143 payments, $1,081 a month, and it's an easy flow of the transaction itself. There is some paperwork involved, just like when you sign a note. It's not the same. There is a transfer when the note transfers over. So there's some paperwork that has to be done on our side between myself and you as a partial buyer, and then also with the servicer. And so let's talk about how to manage a note. So we use third-party loan servicers, and we do that so that they actually help us and do all the work. Okay, so what are they going to do for us? Well, they're going to collect the payments, so we don't have to be calling the borrower trying to collect the payments. If taxes are escrowed and insurance is escrowed, they're going to collect that escrow, and when it's due, they're going to pay the tax department or the insurance company to make sure that that gets paid. They are licensed and compliant. And so it's really important in some states more than others, but we feel like it puts us in a good situation and you as a passive investor in a good situation to have a servicer that's licensed and compliant to collect mortgages. And then if we have to do any kind of workout with the borrower, and we talked about that earlier, for example, during COVID, there might be a situation where if someone's lost their job, maybe we should modify their loan. Maybe we should take 3 payments and put them, divert those to the back end of the loan. Worst case scenario, we do have to get a deed in lieu or foreclose on a property and take that property back. So the servicer is going to help us do all of that workout. And the way that the payments work is they go to the servicer and then to the note owner. And so it just flows from them right into your account. So it's makes it a very simple transaction, and it makes it totally passive. So it is all outsourced. And we have found this to be a great way to make this a very passive investment where you can just oversee the assets, but not be in the middle of trying to do a lot of work. Now, the risk level normally is quite low, as we saw in the case study that we had today. And some could get up to moderate because the investment to value is not going to be as high. It doesn't mean that it's not a good transaction. I invest in them. You'll see me invest in them. It's just that maybe they've only paid for 12 months. We see loans that have only paid for 1 and 2 months. They've just been created. But maybe we have a situation like this where it's a nice sticks and bricks home. They might have put $20,000 down. So we look at those type of things when we make our decision and what our risk factor is. So we know that no one cares more about your wealth than you. And we certainly feel like notes are a safe and secure investment. You know, there's a tangible asset behind a real estate note. It has value that will never go to zero. I mean, there's always going to be value in a home, no matter what the market cycles are. The notes are a reliable way to create passive income with the monthly cash flow. And of course, you know, we have years of experience in the note business. And we have a team of executives that help us. I mean, if I get into a situation where I am buying a note or I have something that comes up in a state I'm unfamiliar with, I promise somebody in our office can usually give me an answer in regard to what I need to know. So it's just a matter of me walking across the hallway so that I can get answers to what I need to do in just about every state, which I think is really important today and for us, because we do buy across the United States and we always have. You're not going to see loans, particularly right in your backyard. I'm not going to say you're not going to see them in whatever state you're in. I buy a lot of Texas loans. I like buying Texas loans, but that doesn't mean that they're all going to be Texas loans. So we are just glad you joined us today. I hope the presentation has been just a learning opportunity for you to show you how we buy notes and how we work with passive investors. Again, I hope you made some notes about questions that you have, because I really would love for you to go to the landing page here, colonialfundinggroup.com/Martha. colonialfundinggroup.com/Martha. There will be a sign up page there for you. There's a couple of questions. You'll see, you'll actually have to type this in and go to the page. There'll be a couple of questions for you. And then once you put in your name and email, it will take you to my calendar. You'll be able to schedule a strategy call, and we can talk about what your goals are and what kind of questions you have. You know, we're a very close-knit community. We're very like-minded for the most part. When I end up working with passive investors, we do a lot of different transactions together. And also, please take the time. This video on notes versus rentals really shows you a little bit more about the cost overall in holding a note and holding a rental. I think that would be of great interest for you, and it's really short. And then, like I said, I have a great testimonial from some partial buyers that have become very good friends and customers that live in the Nashville, Tennessee area, and they're great folks, and it's been great. It's just been so nice to get to know them, and they've bought a lot of loans from us. So again, please go to colonialfundinggroup.com/Martha, schedule your free strategy call, and I really look forward to meeting you in person or via webcam. And so we'll see how I can help you, and hopefully we can do some business together. Thanks so much for joining today, and you guys have a great rest of the weekend and enjoy. I know it's hot, so stay out of the heat. See you next time.
Just real quick, Steve, I think you might be muted.
Sorry about that. Anyway, as I was saying, thank you for joining us today. This was, again, a little unique in the sense that Martha was pre-recorded in our presentation, but again, based on the content, I think you'll agree, important nonetheless. For those of you who have been asking some questions in the chat, we've been answering them to the best of our ability, but if you do have some follow-up questions, of course, you can reach out to Martha or just drop your questions into the chat box before we're done, and we'll make sure that the questions are passed along. Anyway, that concludes our presentation for today. I want to thank you all for joining us. And again, want to wish you a happy weekend. And again, we hope to hear from you soon here at Quest Trust. Thank you very much.